Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Early in the month, March corn made a very reasonable high near one of our cycle turning points and has been tracing in a fashion similar to our projected price action. We're looking for the markets to drop, make an advance, and then drop into the close or into the contract coming off of the board. And it appears to be exactly what we're looking at right now with the near-term drop that we had, an advance into resistance, and now the market has turned back down again. We're currently sitting right on top of volatility-based support, and we previously had indicated that we had support near the Fibonacci 61.8 retracement level of 358. Market has now come back down to that level, and we're probably looking at a potential breach of these lows that we saw just a few days ago. As the market continues to show its price action, we see weakness in the stochastic on its way back down. So we would anticipate that the market would either be sideways to down as it looks to come off the board in the coming weeks. As we turn our attention to the December contract, we'll notice that the 385 3/4 price level has been operating similar to a node for this market. You'll notice the market moved above it, and then when it got below, we saw a similar distance from that actual price threshold. The market has since moved back above it, and now slightly below it, and then slightly above it again. We need to see the market make a very clean break away from this actual node level in order to see some great price action direction away, or at least some trending occurring inside of this market here. As it stands, we would anticipate that the price action would probably continue sideways to lower. We are again sitting inside of volatility-based support. And what we would be looking for at this time is for the market to make a move down, possibly into our endpoint, at which point we could see some support going in there. We have a previous low as well, so as it challenges this level, a clear break of the 373.5 number would send us down to about 366.5 at a minimum. March beans has flirted with being overbought here in the markets, has touched this level several times over the past several weeks, and you'll notice here where our natural trend line occurs, when the market has tested it and it's come near this area here, the market has failed. So we're looking at the failure that recently occurred as the test came in near our natural resistance level above the markets. It has now been moving down, is approaching volatility-based support, but in addition to that, we also see that it's very close to our end band here. So if the market's able to make its way down to about 852, we would anticipate near-term support there in conjunction with it moving down to potentially becoming oversold, where we'd find some support. But the reality is at this time, the sheer inventory that we've been seeing with regards to the U.S. and Brazil is so high that the market's going to very much struggle with being able to support prices no matter what we're looking at with regards to future support levels. One of the key indicators that we were able to identify was that once the market broke back down below the point of control of 882 3/4, that's really where we saw the market really descend in an accelerated fashion. That indicated to us, or that really showed us, that the sellers came in, were able to push the markets down. Point of control was at that 882 3/4 number. The market wasn't able to push much higher than that threshold. And so really what you saw are producers coming in and deciding that the price level at which we're at is good enough. And we saw sell orders start to come in and push the market down. Now this March contract is very close to coming off the board, so it's going to be important now to understand and see our analysis on the November contract. On the November contract, we find the following. We have key resistance that's been at the 893 number. The market has tested this area several times, But more importantly, we'll also notice that we've had our natural geometric trend line where the market tested it 1, 2, 3, and now for the fourth time. In our experience, when the market tests a key level a fourth time, that's often the time when we'll see a break of that threshold. And that's what we are now going to be anticipating, a break of this key support that we've seen that has been outstanding for quite a few months now, coming in to potentially test our endpoint and even get as far down as our volatility-based support threshold here. We also have key support at 863.5. So those are going to be a couple key points that the market will need to get through first. But in all likelihood, we're looking at about 850 as a very good target for this November contract. The July week contract has been trading very much on par with our expectations. You'll notice here that we had our key geometric support level, but once the market broke it, we saw a very fast decline straight down into our endpoint. After that support level, we saw a small little bounce inside of here, but really this retracement in terms of the sheer number of bar count that we're looking at, the number of bars that we notice in this advance exceeded the number of bars in the decline, but the retracement was roughly about 50% of the range. When the market makes moves like this, it's broadcasting to us that it has weakness ahead of it. The notion that we're looking at is something that we call overbalance. In addition to that, we also had resistance coming in on a natural level, and once the market tagged it here, the market was able to turn back down, and we now currently sit at volatility-based support. Now, the weakness that we're seeing indicates for us that the market probably has further to go, and we're looking at a potential target in the 440 to 450 range before we see a real pause in the decline in the wheat market. We will close our weekly update today with the crude oil contract. We went ahead and moved forward with the April contract as the March contract has come off the board. What you'll notice here with regards to our harmonic cycles, we've seen a couple key turning points that have occurred. Back on November 6th, we saw a very nice low. December 21st, another nice low. Our next key harmonic that we're looking at occurs on March 11th. Once that timeline comes in, we don't know if that could be a potential high or low, but what we would be looking for is a potential change in trend regardless of what the direction in which crude oil is marching or moving in. We also have seen very nice resistance near term near the 36.5 number. So if this market's actually able to get back above this threshold, what we're looking at is if prices get above 36.20, we would not be surprised to see an advance that makes it up to about the 42.43 price threshold. We continue to monitor crude oil. Talks with OPEC have really broken down. Outside of Russia and Saudi Arabia's agreement, none of the other OPEC partners are really coming on board. And so because of that, we've seen some of the weakness here in the crude oil markets over the past couple days. It does not mean that we will not find potential support, but we do know right now is that the production levels are going to continue as status quo. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.